Okay, so first concept we're going to introduce here is the risk-free rate of return. Um, ah, go back. All right, so risk-free rate of return. That's what we're talking about right here. Um, Typically, the risk-free rate of return is a T-bill rate. Um, for different reasons, somebody might use a 3-month, 6-month, or 12-month T-bill rate, but the Treasury bills are the closest thing to a risk-free security available in the market. Um, Amazing as it seems, as screwed up as our government is, our financial system is, and Treasury are still the most sound in the entire world. Which maybe that doesn't say much for the rest of the world. I don't know. Um, anyway, but as risk goes up, we add a premium. So we're going to add a premium depending on what that risk might be. That risk might be the length of a bond. That risk might be the uncertainty associated with the company that's backing that bond or the project that's backing that bond and so forth. But lower risk means lower risk premium. Higher risk means higher risk premium. So, so the rate of return for any given investment is simply a function of the risk-free rate and the risk premium. So that risk premium can be made up in any number of factors. The default risk premium, so that's the uncertainty with regard to a company's operations potentially, or could be a government as well. Liquidity premium. So liquidity premium has to do with the difficulty of converting that asset to cash. Treasuries, for example, are very, very easy to convert to cash. You can do it through a dealer. You can also do it through the U.S. Treasury, treasury.gov. You can, and then finally, maturity risk premium has to do with the length of or time to that security matures. The maturity risk premium is going to be greater for a 10, 20, or 30-year bond than it is going to be for a 1 or 2-year bond. Real versus nominal rates. So far we've been talking about nominal rates. In the small arms, the nominal rate of interest, to which we've been referring to, could include a risk premium. So R star is the real risk-free interest rate. So when we talk about real, we exclude inflation. So that's how the difference between real and nominal. And then R sub RF, that's our risk-free rate. The nominal risk-free rate includes an inflation premium and the real risk-free rate to determine the nominal risk-free rate. So the nominal risk-free rate is equal to the real risk-free rate plus the inflation premium. So the nominal rate is equal to the nominal risk-free rate and the risk premium. So this could apply to any investment. So we went through before. IP is the inflation premium, DRP is default risk premium, LP is liquidity premium, and MRP is the maturity risk premium. So, for any investment, the nominal rate is equal to the risk-free rate plus the default risk premium plus liquidity premium plus the market risk premium. So, and then we can break that down to include the real risk-free rate and the inflation premium, which just is equal to the risk-free rate. So premiums. So a short-term treasury, a treasury bill, for example, would probably only have an inflation premium because those are the most secure securities available. Long-term treasury is going to have a long-term inflation premium for long-term inflation plus a market risk premium because of that long time to maturity. A short-term corporate is going to have a short-term inflation premium, default risk premium, and a liquidity premium. Short-term corporates are way less liquid than our treasuries. They're much harder to trade, much harder to convert. So then if we move forward onto a long-term corporate, we're going to have everything. We're going to have a long-term inflation premium, a default risk premium, and then we're going to add a maturity risk premium along with the liquidity premium. And again, the long-term corporate is going to be much less liquid than than treasuries are. Treasuries are very easily traded. There's huge amounts of trading that takes place in treasuries on a daily basis. Term structure of interest rates. The term structure of interest rates relates to the relationship between interest rates or yields. I prefer yields. Because we're looking at yields. We're not looking at interest rates. It's easy to get confused. You get coupon rates and yields can be very, very different. So that relationship between those yields and maturities. So the yield curve is a graph of the term structure of interest rates, and for the most part, as I mentioned before, that applies to U.S. Treasuries. Here we have portions of yield curves, as I mentioned. So this, most cases, you'd have 3 months, 6 months, 2, 3, 5, 7, and then 10, 20, and 30 years. So there'd be more out here, more rates displayed if you actually went to treasury.gov and you looked up the yield curve. The first one is what we would call a relatively flat yield curve, but it is actually slightly increasing. The July 2006 here, if we look at February 2007, not too, so that's actually 8 months after the yield curve had actually inverted. So rates are higher in the beginning than they are at the end. And then by September of 2008, we have what we would call a more traditional upward sloping yield curve. So we've got flat, inverted, and then upward sloping. Okay, we'll continue the discussion of the yield curves in the next lecture.